What is real? How do you define real?
You can't jump into cash. Cash is trash. What do? You get out.
Andrew Edstrom, hard money enthusiast, author of Why Buy Bitcoin, Investing Today in the Money of Tomorrow, wealth manager at Westcap Group, head of institutional at Swan Bitcoin. Andrew's opinions on Bitcoin have been published in the Wall Street Journal, and his opinions on the internet monopolies have been published in The Economist. He was also recently featured on an awesome segment in the Kaiser Report. Thank you so much for coming on the pod, Andy. How are you?
I'm great. How are you, Cedric?
I'm doing awesome.
Thanks for having me.
Yeah, thanks for coming on. I really want to get into this book of yours. It's monumental. For me, it's up there with VJ's bullish case for Bitcoin. Primarily, because of the perspective that you add to sort of the canon on Bitcoin education. It's filled with historical and economic policy information, and you really codified this perspective, from a perspective of a wealth manager, coming from Wall Street, hedge funds, private equity, and now acting as a fiduciary. And I think that's an interesting path to becoming a fiduciary. What exactly is a fiduciary, though, and what is your role as a wealth advisor?
Yeah, so two answers to that question. What exactly is a fiduciary is actually a legal question that's probably above my pay grade. But the nut of it is that the fiduciary has to put the client's interests ahead of his or her own interests, basically is what it comes down to. And that's not quite true from a legal perspective. There's more to it than that. But yeah, basically what's interesting about how wealth is managed, at least in this country, is that some of it is managed by fiduciaries who have to put their clients' interests first, but some of it is not. The broker-dealer standard, which applies to a lot of the money that's managed in this country, is just a suitability standard, which is a lower one. I sleep better at night knowing that I'm supposed to, put my clients' interests ahead of my own. It just makes life simpler. I think it's the ethical thing to do. And so that's the answer to that question. Your other question was what does wealth management involve?
Yeah.
I mean, basically, my clients, they task me with both investing their assets that are available to invest and also giving them financial advice. So basically, I try to be a soup to nuts, full service advisor on what's going on financially in your life, which includes that major aspect, which is, investing your investable assets.
Sure. Yeah, and I enjoyed this book so much. And one of the keys to it for me was that, you answer the question of why buy Bitcoin by not even uttering the word Bitcoin for almost the first 6 chapters. It's the elephant in the room, or maybe the honey badger in the room, or the apex predator of money. And I really like that approach. And let's say, though, I came to you and I said, Andy, you're not my wealth advisor, but I have a wealth advisor, and maybe he's not as good as you, but I haven't been listening to him. I've been over here trying to make some money. I've lucked in. Maybe I'm a restaurateur, and my restaurant's blown up. I got the hottest restaurant in the city. I'm an internet sensation. I've written a book, and I'm making some coin. But I haven't been paying attention to anything but that and my family. And now I'm waking up and I'm like, what is going on? I don't know anything about these markets. I don't know anything about money. Andy, tell me what's going on here.
Wow, that's a great question. It's I'm sure the question that's a lot on the minds, as you say, of a lot of entrepreneurs, business people, professionals, just everybody out there who's thinking, gosh, I've got some assets to allocate, and I want to beat inflation, and I want to grow my wealth, and I want to not lose my wealth. And so I guess I'll take one angle of attack, which is, on the one hand, these are unprecedented times. Back to your comment about how, the first half of the book has nothing to do with Bitcoin, right? When I first started, and this is what I tell my clients, the ones who are sort of intimidated about learning about Bitcoin, I say, look, just try the first half. I promise it has nothing to do with Bitcoin. It has to do with where we are in the world today, which is there's too much debt because there's too much debt, the Fed and other central banks have had to lower interest rates to lower the burden on the debt, which also feeds back and causes people to buy more. They borrow more on their mortgages. Companies issue more bonds, issue more debt. The government has been issuing debt at a rapid rate. And then, of course, we get the pandemic, which has just accelerated everything. And so, people, it's funny, we'll get to Bitcoin, but people will look back on, on the recent Bitcoin rally and they'll say, oh, it was because of the pandemic. And the reality is, maybe the pandemic was a catalyst, but all these forces were already in train. We had already been off the gold standard for almost 5 decades, and governments and companies and even households had been borrowing and spending more than they could afford. And we're coming to that moment. We're coming to a moment in history that is going to be interesting. And I think it's going to be a reckoning in the 2020s. But to get to your question of, well, what's an investor to do? Still diversify, right? Diversification is maybe the only free lunch in investing. You can look at assets, whether it's stocks, whether it's bonds, whether it's gold, whether it's Bitcoin, and you could say, well, is this stuff all overvalued because they're printing so much money? Maybe. I happen to think that of all the possible outcomes that are likely, the one I focus on in the book is they're just going to keep printing so much money that most things go up in price. As to what goes up in price more, we're going to find out. And as a fiduciary, I have to take advantage of that quote unquote free lunch of diversification and hold a portfolio of assets for a client. But I am watching carefully and thinking about the big picture and thinking about debt and interest rates and what it means for the next decade.
Yeah. In the book, I mean, you kind of have a lot of great phrases in here and ways of painting a picture around economics. What do you mean by Marx, Engels, and Keynes, Stalin, Mao, and Greenspan?
Yeah, that one was meant to open some eyes, and the idea was, the idea was the best intentions, right? The road to failure is paved with best intentions or good intentions. And the idea is Keynes had actually a really good idea. And the good idea was, let's try and moderate the business cycle. So when things are slow, let's have governments run deficits, borrow money, spend, support the economy, keep people in work, and cushion that blow. And then when things are good, let's take away the punch bowl, right? Let's rein in the deficit spending. Let's run surpluses. And of course, the hard part is the second part, which is to say, with a democratically elected political system, the politician that gets elected and stays in office is the one that can deliver the most goodies right now. And so we never get the reversal. We never get the living within our means and taking away the punch bowl and basically balancing the budget in the long run, as Keynes probably would have advised. And so the analogy that I draw to, Lenin or Stalin and Mao and whoever it was the idea of socialism or communism, which is like, it's an interesting idea or it's a great idea, except for the actual practical outcome, which is to say it fails miserably. Same thing with Keynesian policy. If you could moderate the cycles, it might work out great, but based on the rules of the game, really based on human nature, it just isn't going to work. And communism is the same way.
Right. What do you make of Alan Greenspan's legacy?
I think it's pretty negative. I think that Greenspan, first of all, like many people in power, was in power for too long. I can't remember. He was Fed chairman, 18 years or something, I want to say, sure. Right? And, he was considered the, quote, maestro. That's what people called him. And he had a lot of influence. He had a lot of power. So already, basically he was in the saddle for too long. And there's no question that interest rates were kept lower for longer than they ever had been in the past under his watch. And he basically was explicit about this concept when it came to financial bubbles, right? He said, look, central banks are not in the business of identifying financial asset bubbles and therefore taking away the punch bowl or pricking the bubble. We're just going to let them play out. And then when they play out, we'll sort of support the system. And so what practically happened was they printed too much, or they lowered interest rates too far. Then there was too much debt, which fueled bubble. And then bubble popped. And then the central bank, including when Greenspan was in charge, had to say, oh, well, it's popping now, so we better lower interest rates again. We better print some more money. And so you just look at the chart of interest rates in the United States, which is similar to interest rates in other countries. And yes, there's some cycling around it, right? It's the sine wave, which is interest rates go up in the boom and then down in the trough, which is what Keynes would have said we should do. But it's, of course, downward sloping. You never get up to the last peak, right? You always fall short. And so you go a little bit lower on the peak and then a little bit lower on the next trough, and it just goes down and down and down.
What, did you coin the term quantitative queasing in the book? That's yours, right?
I think so.
And so,
I think so.
Yeah. What does it mean exactly?
I mean, look, it's just it's a play on words, to be honest. But for me, it's, this notion of quantitative easing at some point literally makes me queasy because I see the results of it. I see the second order effects. I see what it does to, wealth distribution in this country. I see what it does to debt levels. I see what it does to, average households who are, trying to scrape by, make a living. The quantitative easing raises the asset prices of, stocks and real estate. I look at the younger generations who are trying to buy their first house, and there's no doubt in my mind that house prices, which are doing great on average now, where we sit in 2020, despite the fact that there's a pandemic, because mortgage rates went from 4% to 3%. And it just makes these purchases out of reach, for a whole generation of Americans coming up. So the queasing comes down to all these factors and all the negative effects of what the central bank is doing, what the Fed is doing, literally make me queasy.
Right. So where do you think we're going, with quantitative queasing? And how do you think things are going to play out through economic policy?
Yeah. So the framework I apply in the book is when there's too much debt, there's the menu of bad options for dealing with too much debt, right? They're all bad options, but there's a few options. So the top is austerity, right? Living within our means. That is cutting government budgets and or household budgets and corporate budgets to not spend more than we earn. Okay, politically impossible, basically off the table. There's almost no country that can maintain that. Greece has been making a heroic effort, for the last decade now since the financial crisis. But man, it's tough. So then you've got this concept of debt jubilee. That is basically wiping away the debts. That's problematic because it calls into question contract law, and basic foundations of a civilized society and economy. If you just forgive someone's debts, or if the government says, hey, your debt is null and void, that causes lots of problems. You've got obviously mass defaults. We could have a depression, right? We could just let interest rates go to normal levels. People would have to service the debts. They wouldn't be able to, and they'd start defaulting in mass. We're not going to see that, I don't think, because we saw what a Great Depression looks like in this country, 80 plus years ago. And it's not pretty. So then you get to the bottom of the menu. Here's what I think is more likely. Some of it is redistribution, right? It's tax the rich, give to the not rich. I think we'll see more of that. We'll see what happens with the election next week. But that's a call, not necessarily on just the next 4 years, but I'm thinking longer term. Sure. We're going to have financial repression. That's ongoing. That's keeping interest rates extremely low so that savers can't earn a return. it can involve capital controls, right? It can involve restricting people's ability to move money, sort of forcing them into holding assets that aren't favorable to them. It would not at all surprise me if at some point, rules come out requiring, I don't know, pensions, endowments, public agencies basically to hold government debt, even though it's yielding next to nothing, because they got to put those bonds somewhere. Either the Fed buys them. If it's yielding zero or less, either the Fed buys them or, you got to get someone to buy them. And then we get to the most likely outcome. And that, for me, is inflation. I think that the Fed has already made it very clear that they intend to overshoot their inflation target. I don't know how long that'll take for them to achieve. By the way, this is CPI inflation or PCE inflation, which is their stated target. Is that real inflation? No, I don't think it's a fair measure, but it's what they're focused on. But I think they are going to print as much as they can to overshoot that target, and especially to fund budget deficits. Because if there's one thing that Democrats and Republicans agree on, it's the government should spend more money than it takes in tax revenue, right? We should run big fat deficits one way or the other, whoever's in charge, and the central bank, the Fed, is going to have to buy up that debt.
Yeah. It's interesting. You brought up in the book, too, something that interesting that very happened in India in November, I think, of 2016, maybe November 8th. Can you tell us what happened there?
Yeah, that was a classic anecdote. And that was, so I think Narendra Modi had been elected, and it was this situation where the government was, among other things, what they said was they were interested in cracking down on corruption, right? And granted, much of I should say corruption and tax evasion, right? So India is a huge economy. It's a huge population. Much of the economy is, sort of off the grid, right? And the government basically said, look, business people, wealthy people especially, you've been hiding your assets and your income from us and not paying your taxes. So we're gonna figure out a way to smoke you guys out. And what they did was they took all the high denomination bills, I'm talking about cash, and they said, these are now null and void. So it would be the equivalent of saying, the $100 bill, any $100 bill in circulation, expires in the next couple months. So you better get to the bank and trade it in for the new bill. And what this did, I think the idea is force people who were hoarding cash or who were transacting on cash basis to basically come out of the woodwork and fork over the money and basically smoke out the tax evaders. And of course, as with many government policies, it didn't have the desired effect necessarily, right? What happened was a lot of people, it seems, that had these big piles of the equivalent of $100 bills, found people to basically transact for them, trade them in, and then had those proxies turn them into the bank. So rather than the guy who's got, I don't know, billions of dollars worth of cash showing up to the bank and saying, yeah, you got me, here's the stuff that I didn't declare. No, he probably hired a bunch of people and paid them, I don't know, 5% VIG or 10% VIG or whatever it was to swap in smaller amounts. And from what I've read, it didn't end up having the desired effect. But the effect it did have was causing real damage in the economy, because in a developing country, cash is king. I mean, cash is still important in some other countries in the world, but especially in a country like India, you yank away the cash source, and now you've got businesses that can't pay their people. People who can't buy the healthcare goods, the drugs that they need, sometimes the food. And so it was really disruptive. And it was just kind of one of those classic government policies that was done in the name of, I don't know, catching the tax dodgers or whatever, and ended up causing, quite a bit of pain, especially among the poorest and those least able to shoulder the burden of that transition and that disruption.
Yeah. It's a fascinating story, and I think this all adds up in a lot of different ways. I'm really also very interested in your career choices. You start off on Wall Street. I think you started off maybe not at Goldman Sachs, but then you end up at Goldman Sachs quickly.
Yep, that's right.
I got to think the world's your oyster, more or less from a certain perspective. And then you go to, I'm not sure if it's a hedge fund, then a private equity team. And then you leave to go, I think, and I don't want to speak here, but to then become a wealth advisor. And I think to join the family business.
That's right. That's exactly right. And yeah, I'm happy to give you the short story on that. You pretty much nailed it. I started on Wall Street. I worked very briefly for Rothschild, which is actually the firm that is, or one of the firms that is today the instantiation of the Rothschild family financial business, which goes back hundreds of years. But yeah, I got recruited by Goldman. Basically a year after I started Rothschild. I worked in the investment bank. That was high times, right? That was before the global financial crisis. So I was busy putting together leverage buyout deals, bond deals and leverage loan deals. And then I worked briefly for a private equity fund when I left Goldman that spun out of the Carlyle Group. But then I had an opportunity to move home. I was living in New York, and I was there for 4 years. So I was not too far from you. In fact, you're Brooklyn, right?
I used to be. I live in Chicago now, or outside Chicago,
that's right.
the suburbs.
Okay, right on. Well, my wife, by the way, taught in East New York.
Okay, so did my dad for decades. But wait, so this is a lot here. And I think we went to college near each other around a similar time. I think you went to Williams in Massachusetts. I was over at University of Albany, about an hour away.
No kidding.
I picked that up because in the book you're taking the train into New York City, into Wall Street to do your interviews. And I went through similar experiences. And I'm assuming that maybe 9/11 was your junior or senior of college.
You got it.
Yep. Okay. So
you got it exactly right.
I'm really curious how much 9/11 followed up by 8 years later, the great financial crisis, 10 years later, the COVID crisis has impacted and colored your career and maybe your outlook and the choices you've made.
Yeah, I mean, look, it had an immediate effect on my career when I graduated because, as you said, 9/11 was it was my junior year, and junior year is basic. And so then it had is that right? 9/11 was my junior. Well, anyway, let's put it this way. I graduated into the worst job market in like a decade, right? Because it was the aftermath of 9/11 plus the tech bubble popping. So yeah, I had 550, I think, graduating in my class, small class, it's a small school. And I think 5 of us got jobs on Wall Street. And the normal hall would have been probably double that, it would have been at least double that many people getting a job. So yeah, I was frankly lucky to get a good job. And then it was a year later, as the cycle was starting to come back, basically that I got pulled into Goldman. So yeah, it was already tough for my graduating class. Let's just say. Then of course, though, the Fed rode to the rescue and printed a ton of money, and then we had the housing bubble, and it was a good time in financial markets, man. It's amazing how much money investment banks make when they're printing money and refinancing debt and leveraging up, and companies are getting bought at higher multiples, and every deal, every transaction, every time that the financial landscape changes a little, especially due to monetary policy, there's a deal to be done, right? So that was good times for Goldman for sure. And then I was then arguably lucky again, because when I moved to the hedge fund that I worked for in LA for 6 years, it had a broad investment mandate, but distressed debt was a big piece of it. So I actually moved effectively to a distressed debt fund in 2007. Okay. That was lucky timing. But so we did well for a while, although the way it worked out was, we had a bunch of investment opportunities as a result of the downturn, the financial crisis in 2008, 2009. But on the other hand, everything else that was already in our portfolio got whacked. So, it was a mixed bag. I think that, part of my story is I left. So my story is a little unusual because most people who end up in wealth management don't do, sort of hardcore institutional investing to begin with on the buy side.
Yeah.
there's several reasons that I left that to join.
I see them as very far apart fields, and I think just kind of like colloquially, the Wall Street thing. No matter what people's feelings are, it's very sexy, it's very exciting, lots of riches, and wealth management. I think, to some extent, is not as seen as glorious. And I think that's why your background is very convincing. Convincing is not the right word, but like it just brings a lot of weight and credibility because you have the credibility to be over there. You like I said at the top of the show, when you've been published in the Wall Street Journal and The Economist, it wasn't supporting mainstream narratives. You were kind of challenging mainstream narratives. I kind of want to make that clear. And in some ways, maybe pushing mainstream narratives. And I noticed with The Economist, kind of changing their opinion based on your article and your thoughts. So you're kind of in that world. You probably could have owned that world. And then you're like, hey, I'm gonna duck out, join the family business. I'm wondering how much of your dad influenced your thoughts on your career and your choices and what you take to wealth management.
Yep. Yeah, no, those are great questions. And it was several different factors. So my dad, who is also my business partner, is, a great influence on me. And it was funny, his initial reaction when he heard that I was going to Wall Street, coming out of college, was not positive, right?
Oh, wow.
He basically saw Wall Street as pretty scammy. It took me some time swimming in that pool to realize that he was right. He had some wisdom there. I also got interested in working with him because I just knew there was a lot I could learn from him. I also got interested in working with people rather than, faceless institutions. Sure. I mean, it's true at my prior job, our largest investor was the GM's pension. And so there was some benefit to knowing that, I was trying to make good returns for a bunch of retired pensioners who had worked hard their lives and needed to earn those returns basically to help them in retirement. But there's a certain amount of distance between that versus working with actual people, which I get to do now, which is a good thing. I find it more rewarding. And then, I'll be honest with you. Well, another reason is I got excited about growing the business. Our firm has been run very conservatively, very carefully, and I saw an opportunity basically to build on the track record and the client base that my dad and his business partners had already established before me. And then, to be honest with you, I also saw the writing on the wall to some degree regarding the hedge fund industry, the private equity industry, especially the hedge fund industry, and where the puck was going and where fees were going. And I could see that it was getting more competitive. I could see that we were past the era of really insane riches, right? I mean, you were sort of alluding to, really the huge upside potential that one can possibly take advantage of in that industry. And to be clear, I was never really minting the huge money. Okay. That I might have been approaching that level in my career at some point in the future. But it wasn't in my hand.
Yeah. You got to grind it out for a long time before they get to the rainbow. Yeah.
You do, and it's competitive business, man.
Yeah.
As you know, if there's riches to be had, you're going to get pretty stiff competition to get in there and seize those. So so those are some of the reasons basically that I switched into this business. And this business, you got to the idea of being a fiduciary. I got some psychic benefit, to be honest. Knowing that my mandate is to put my clients' interests first. And, that's clear, and I get to know them and I get to help them. And, there's some psychic benefit from that.
Yeah. Well, describe the Goldman Sachs quadruple play.
Yeah. The Goldman Sachs quadruple play. So Goldman, when I was at Goldman, the estimated annual compensation of a partner, so senior level at Goldman, approximately 2% of all employees at Goldman were partners. And if you said, okay, what percentage of front office employees, sort of professional track was that, you know, it must have been much higher. I mean, maybe it was like 5%, you know, something like that. And that was the big payout point. So when I was there, it was believed that the average, the mean Goldman partner annual compensation was approximately $8 million per year. Big money.
Right.
I never, to be clear, I did not reach that level.
Quite the carrot, though. Quite the carrot.
I did not. Yeah, exactly. I didn't even get close. But it's quite the carrot for, that's what people are striving for. The career people that stay there. So now one thing I did learn, even though I was only there for a couple of years and I was just an analyst, I was basically a guy straight out of college, was I figured out that the partners' jobs, the job was not just to make money, right? The job was to literally extract every last possible dollar out of every situation that came across your desk, right? You got to work every deal from multiple angles. That's what you get paid for. And a big part of that is, managing conflicts of interest and not pushing the envelope too far. Now, what's interesting is there are other professional services industries like big law, right, corporate law, that don't take this approach. Lawyers have a stricter set of principles, let's say, about managing risks or managing conflicts. And generally speaking, lawyers will not work for two different clients, right? They will say, look, this is my client, I'm working on their behalf. And, this other client, if you're at odds with the first client in a business situation, you got to go get a different lawyer.
Right.
Goldman didn't take this view. So the quadruple play was a case, it was basically a deal I was working on. And this is the same company was one being advised, on the sell side. So Goldman was hired to be investment banker to sell the company. Another part of Goldman that was the private equity arm, was looking at buying the company. My group was the financing group. So we were providing a debt package, bond and bank deal on this transaction. And then the fourth was the swaps group. It was the commodities group that was basically providing a hedge on the input cost, because this was a company. It was basically a paper company, and they had input costs that would jump around. So they provided a hedge. So Goldman was basically working four sides of the deal, and they were getting fees on every side. My recollection is that the order of magnitude of the total fees on the deal was something like $100 million, right? Wow. And the story of Goldman and the whole investment banking industry was that they pushed it too far ultimately, and they got fined. There were scandals that came out of the global financial crisis. I mean, we can get into some of those if you're interested.
Like the John Paulson trade.
Yeah, exactly. But suffice to say that the quadruple play was an example of how aggressive Goldman and the other investment banks got when it came to extracting as much money, as much revenue out of every situation, even if that meant working multiple angles where the angles or the parties involved might not have had all the same interests.
Right. What do you make of Goldman Sachs now? Its relationship to government?
Yeah. So Goldman is the classic case of regulatory capture and what people call the revolving door. And the notion is that people work in industry, and then they work in government, and then they work in industry, and they move back and forth. And there's, what happens in practice is when you're moving from government to industry, government doesn't pay as well. So, you work at the SEC, or you work at the FDIC, or you work in Congress, and you're making a government salary effectively. Now, these are above average salaries, for the average American, to be sure, but they're still a fraction of what you could make in the private sector. And what happens is the regulator, works his or her way up in regulation, and then eventually at the end takes the cushy job, from Goldman or Citibank or whoever. And the result is that the regulators treat those institutions, those banks, with kid gloves, because they know that fat cushy job is waiting for them, at the later stages of their career. Then you have the opposite situation. This is the case of Hank Paulson, It was the case of, multiple people before him. Bob Rubin, Nassim Taleb talks about the Bob Rubin trade in his books. And, that's where you start in the case of Hank Paulson, you make a career at Goldman and then you go to the Treasury. Paulson executed this particularly brilliantly because he rode the train at Goldman for, 20 something years through this period when interest rates were falling and falling and falling, and the banking system was getting the benefit of that. And then just before the global financial crisis, he left and he took advantage of this rule, which for basically employees of the Treasury, right? He became Treasury Secretary. He was CEO of Goldman. He left to become Treasury Secretary. And there's a rule that says if you go work at Treasury, and I think it actually extends to the entire executive branch, you can take your stock or your assets, in this case, Goldman stock, which had huge gains in it, and you can sell it and not pay capital gains, right? You get a free pass on cap gains, and you can diversify your portfolio. And the logic is, well, we don't want, a former bank CEO to keep his bank stock while he's regulating, the bank, which is logical, but it's also this huge tax loophole for a billionaire. I don't remember if he had, $500 million in Goldman stock or $1 billion in Goldman stock, but he managed to exit at least some portion of it, some significant portion of it, as far as I know, not pay the capital gains, and then, and then basically yank the rug out, or yank the, the ladder after he climbed up, and then the global financial crisis, took down the banking system. So it was quite a move for Hank Paulson.
Right. It's interesting. At the beginning of your book, you offer a few cautionary words. You explain that the examination of the monetary world seeks truth, and that you've written this from the point of view of an investor and the world of investing. And when reality collides with courtesy, it's courtesy that gives way. And reading this book may cause you to question some fundamentally held but insufficiently examined assumptions about the world. And I hope it improves your understanding, but please be aware that it may cause some psychological discomfort. To those unwilling to suffer some anxiety, return this book to Amazon. To the intrepid truth seekers, read onward. I might be just, someone you're preaching to the choir. I did not find a lot of discomfort. There was some, maybe a few things that were interesting that you bring up, like how trade-offs are tricky. And the example, that you use, I'd really like to kind of explore is, you mentioned the Patriot Act, Patriot Act, and the trade-offs there. And maybe you can kind of elaborate on that.
Yeah, I think this is one of the areas that, as you suggest, might make some people uncomfortable. And the first, it starts with a question. And the question is, in a world where, billions of people have internet access, and even in developing countries, where the average person is impoverished, basically most of them still have cell phones, right? And so you ask yourself, well, if these people have internet access, they have cell phone access, how come we still have a couple billion people in this world that don't have access to the banking system? And this sucks for those people, because if you don't have banking system access, generally speaking, well, then you're stuck in the cash economy. And in a lot of these countries, well, first of all, it's inefficient to transact over distance with cash, right? That's a pain. You got to, in many cases, travel basically to go do your commerce. But the other piece is you got to carry around cash, and many people, don't have the level of safety, personal safety that many of us, at least in the U.S., are lucky enough to have. And so they're, basically at risk of being robbed. And so you say to yourself, look, why aren't these people being reached with banking services? And the conclusion I reach is, well, first of all, it's just economics. It's just business, right? So why do all these people not have bank accounts? Well, because the banks, can't or won't provide them with bank accounts because it's not profitable. Okay, so why isn't it profitable? Well, it has to do with the bank's cost structure. And the huge piece of bank's cost structure that I think many people don't think about is compliance, and it's specifically compliance and interlinking with the U.S. banking system. And what came out of the Patriot Act, back to the 9/11 stuff, is now effectively any bank in the world that connects and corresponds and has a correspondent banking relationship with the U.S. bank which is basically everyone, right? Has liability associated with terrorism, finance. So, and so any bank that, let's put it this way, to be a bank in the world today, it's almost impossible to run a profitable business if you're not going to interconnect with the big Western bank, because the big Western banks are where all the action is, and they're global as well. So your choices are either don't interconnect with the rest of the banking system, which severely curtails your profits, or do connect, but then you have the potential, liability associated with the long arm of the U.S. basically, punishing you if somehow some amount of financing, is going through your system, even if it's a small amount. You get basically beat down for that. So it imposes effectively this huge tax on banks in emerging markets in poorer countries, and it reduces, I believe, the availability of banking in these countries. And it's one of these situations where it's hard to prove the negative, right? It's hard to know what the world would look like in the year 2020. It's hard to know how many people would have access to financial services, throughout Africa and South America and Asia, that don't have access now as a result of the huge costs imposed by this terrorist financing, compliance stuff. And I believe it's huge. So my perspective is, well, 9/11 happened, and, close to 4,000 people, I think, were killed. And then, the fallout, health problems, a lot of the emergency services, people, firemen and police and all those guys, I'm trying to remember the numbers, something like 10 times as many, probably died prematurely, right? Because they had, breathing problems, they had lung damage, the cancer, all this terrible stuff. So, and maybe the number's 50 or 60,000 people died as a result. So, but then we have to ask ourselves the question, well, at what cost today? How many lives have we saved? How many additional lives have we saved? How many terrorists have we stopped at the cost of excluding 2 billion people from, from financial services? And that's a big cost that is hard to calculate, but the math I do in the book suggests that the cost of excluding these people from the financial world basically is huge. And moreover, it's the least, able to pay, right? These are the poorest, most hard up people in the world. Most of them are not Americans. And I think that's in part why the policy, persists, right? This is a cost that the US for our safety, US and the West, I guess you could argue Europe, impose on the rest of the world. And I think it's questionable that we do that.
Yeah. I mean, continuing with trade-offs, how do you see the place of healthcare in our economy and the role of government?
Oh, man. So the healthcare industry is uniquely messed up. I think I spent, a long paragraph about this in the book. And it's too complex to get into here, I would say. I mean, obviously you've got healthcare providers that, have captured government. You talk about like cost of medication, right?
Yeah.
There's literally a legal prohibition on the government negotiating with pharmaceutical companies to get better deals on pharmaceuticals. Like, that's prohibited. You've got obviously the situation where most people don't pay directly for their healthcare. Not only do they not pay for it directly, they don't even know what it costs, right? You and I are consumers of healthcare, but we don't know what the price is. So there's a total misalignment there. You've got you've got liability. Doctors have to carry very expensive, malpractice insurance because it's relatively easy to sue doctors, even for trivial things, and so that imposes a tax and a cost on the whole system. These are some of the issues. I'm not. Oh, there's end of life care, right? When we look at the total dollars spent in the healthcare system in the United States, it's a huge proportion that gets spent on really expensive care when people are within, 3 months of death, sometimes within weeks of death. And so that's another issue. Anyway, I could go on, but I would say, me personally, I have to observe that we are outliers here in the United States. We spend whatever 17 or 18% of GDP on healthcare. Other rich countries, especially in Europe, spend half that much as a percent of GDP. They spend 8, 9, 10%. They don't have as good a care on average, but I also don't think that I'm getting that we're getting twice as good a healthcare. Right? We're spending twice as much. I don't think we're getting twice as good a healthcare. So it's a difficult problem. I don't think we're doing it right in the U.S. I don't know if they're doing it, right in Europe, but I do scratch my head and wonder how we're spending so much and not getting better than average outcomes, health outcomes, because we're not.
I hear you. It's interesting. I want to continue this dialogue on trade-offs and role of certain entities in the economy and the government. Where do you think, you challenged, I think it was one of your favorite economists' opinions on internet monopolies in The Economist. And then you kind of drove the economist's opinion, where they kind of, where do you see internet monopolies now? And who do you think is kind of the stronger entity, the internet monopolies or these behemoths or the federal government or state governments, if you will?
Yeah, great question. This is one of the questions of our time. And it just became more relevant, right, because of the recent suit that was filed against Google. So the Department of Justice just came out with this lawsuit. What you were alluding to is, I wrote a letter to The Economist in 2016, basically complaining about how the internet companies are monopolists. Because one thing that The Economist is, which is one of my favorite publications, they don't understand Bitcoin, which is one of their failings. We'll get to that, but they do this thing called the crony capitalism index, and they go across the world and they look at countries and they see how captured by industry is the government and how much power effectively do monopolists have, in countries across the world. And at the time, they weren't including the tech industry in their index, right? And I was like, are you kidding me? Like, the internet giants are the biggest monopolists out there. And it's only gotten more true. Now, your question about this is a really great one about who's stronger, the companies or the government. We're going to find out. We're going to find out, I think in the next few years. The practical matter is that antitrust law is tough to execute. It is hard to bring a case against these companies. The well-known one that happened, 20 years ago was Microsoft. And as a practical matter, when you look back at 100 years of history of antitrust and monopoly, government action. By the way, for anyone interested in that, I do recommend a book called Goliath, which came out recently, which basically is sort of a century review of antitrust in this country. It's really hard to bring a case. So my view is that the internet giants, and I'm talking about pretty much all of them, Microsoft, Apple, Google, Facebook, Amazon, in their own ways, they're all monopolists, and people are realizing this. But to actually bring cases, I think we're probably going to have legislation. We're going to have rules that have sharper teeth. Now, that's one aspect of it. I think what's interesting and unique about these companies, and one way I like to frame it, and I frame it in the book, is as follows. And I'll ask you a question. So Cedric, what do you like to eat for lunch?
A hamburger.
Okay, perfect. So you like to eat a burger. So let's say that, you go to your corner burger joint, at least, you would if there weren't a pandemic. Maybe you still do. I hope you still do.
I do.
And
well, they just closed it. They're closed inside service. But I've been going to the local steakhouse by the office, and I've really been enjoying it, getting my burger.
Yeah, no, that's good. Keep those guys going. Keep those guys in business. So let's say they charge you $10 for your burger, right? And to you, it's worth more than that, so you're willing to pay $10. Let's say to you it's worth $15, right? You're willing to pay $15 for the burger. You can get it for 10, that's great. you capture the difference economically. $5 is 15 minus 10. That's what the economists call surplus, right? Consumer surplus. Now, the great news is the burger joint can produce that $10 burger for $8, right? So they make $2 of profit there. And that's their producer surplus. And if they try to jack the price up on you, from $10 to $12 or $14, you say, well, maybe I'll walk down to the other corner and I'll go to your competitor and he'll charge me $10 and that's competition. So everybody, the producer makes some profit, you capture some surplus, and there's competition, so pricing stays reasonable. Now, let's say that your favorite burger joint buys up all the corners, they acquire their competitors, and now there's only one burger provider, where you live. And they decide to jack up the price to $14 a burger. So you used to pay 10, now you're paying 14. And that's not great for you, but it's still worth $15 to you. So you're like, all right, fine, I'll pony up. And you can't go down to the corner to the competitor with the lower price because he's the same company now, and you're paying full freight. So now his profit's gone up, an extra $4 per unit. Your consumer surplus went from $5 to $1, right? But it's still worth it to you. Okay, so this is how monopolists work. But the tech giants have taken it one brilliant step farther. So the tech monopolists have said, you come into the joint and you say, give me the burger, or give me the search, give me the search service, right? For example, or give me the social networking service. What does it cost? And they say, oh, don't worry about it. Just give us your data. And you say, right, well, what are my data worth? And they say, just don't worry about it. Move along in line, fork it over. And so what they've managed to do is they've managed to get you to trade something that you don't know the value of, your personal data, in exchange for a good or service. You're trading away something you don't know the value of for that good. Now, my grandmother, in her wisdom, told me there's a word for that. It's called a swindle, right? You're getting someone to trade something they don't know the value of. The seller of the service knows the value of, and in fact, they know that it has a high value. And so that's where we are with the internet monopolists. I think people are finally figuring this out, and I don't know how it'll be dealt with. I have some hope that people will realize what they've realized in Europe, or started to realize in Europe, at least regulation-wise, which is my data or my property, and I should be fairly compensated for them. But this is going to be interesting to see how this plays out, and obviously it'll depend on the election in the near term. But in the long run, yeah, it's going to be a struggle. It's going to be a struggle between these big monopolist companies and the federal government for sure.
Yeah, I agree wholeheartedly. Andy, you passed the test. I was hoping I was going to fine you 100,000 Satoshis every time you said the word Bitcoin as we were getting through this, and you won. So now I do think it is time to turn to Bitcoin, though. And
Let's do it.
So Bitcoin has never been through a deep financial crisis, and we're going through that now, I think. And what I'm trying to, you said a few things in the book that I think are kind of enlightening about Bitcoin, and phrase it in unique ways. You kind of you go on about how, not go on, you talk about how money is a ledger. Mm-hmm. And then you say Bitcoin was the first crypto to be forged. I love that. What does that mean, and why is that important?
Yeah, I got a little bit, I chose my words and got a little bit of imagery in there. And the history, of course, with Bitcoin was that the white paper dropped in 2008, and the Genesis block, I think it was January 3rd, 2009, and embedded in the Genesis block was this text talking about how the chancellor was on the brink of the second bailout for banks. Right? This is the words that were in the first block of that database that you described, which is the Bitcoin blockchain. And it was Satoshi's message that the global financial system not only had to be bailed out once already, but it was about to be bailed out again in rapid succession months after the first round of bailouts. And so when I wrote that Bitcoin was forged in this crucible of financial turmoil, effectively, it was out of this massive failure of the banking system and the global financial system that Bitcoin was birthed. And that's what it comes down to. It's an amazing origin story. It's right there, written into the first block of transactions. And Bitcoin came into this world at a time when it was most obvious that the financial system was truly broken.
Yeah, it's interesting. I really got hung up on the word forged, though. And the reason I got hung up on it is because, you think about a counterfeit. Counterfeit is forgery.
Oh.
Right? You
It's
forge
funny. That is
something.
funny.
Yeah, I really got hung up on this. And the debate around, I see this a lot on Twitter. If you counterfeit money, you go to jail.
Yeah.
If you forge money, you go to jail. And if the government counterfeits money or prints money or inflates money, they give it out. And you have the Cantillon effect.
I love that. I love that understanding of the term. And I hadn't thought about it that way. And of course, I'm thinking of forged as in forging iron or steel.
But
in
you're
the
forging
heat.
something into fiat, and it was
But you're
really
right.
really interesting to me. The next
And
one,
Bitcoin is this unforgeable form of money,
Right.
that was forged, so to
by
speak.
Satoshi. Yeah, fantastic. And the other one, and when I say the word crypto here, I only refer to Bitcoin. It's the only immutable, unseizable, uncensorable, yada yada about crypto. So it's the only crypto to me. So when you say Lego my crypto.
I shouldn't say everyone, but Lego My Ego was the classic ad campaign. That's when I was growing up. I don't know how old you are. I don't think we're probably too far apart in age. You might be a little bit older than I am, but I just remember that ad campaign, Eggo waffles, all over the TV.
Yep.
And it made me think of Lego My Ego, Lego My Crypto.
Yeah, it's great. And then you get into the 14 characteristics of money. And, the ones that really, they're all great. And it's kind of interesting because, you lay it out a little further than most do with the 14 characteristics of money. The ones that really stood out to me, when you talk about the short-term stable value and the long-term stable value. But the one I want to ask you about is backed by a powerful entity.
Yeah.
And maybe you could walk through what does that mean? Why is that an attribute of money?
Yeah. So I love that you asked about the 14 characteristics. And from my perspective, you don't have to have necessarily all these characteristics to succeed as money, but it helps. They each help. So if we're honest about it and we look at the US dollar or any fiat currency in the world today, we say, does it help the US dollar as money that it's backed by the world's largest military? And my answer is yes. So, it's not a requirement that some big, powerful entity stand behind a form of money. It's not a requirement, for that money to succeed. But when we look at the world today, and I look at the world today, and I look at most people's perception of, what standard money is or what good money is, I have to acknowledge that having a powerful entity standing behind it, does matter.
Sure.
And in the future, we'll see what happens with Bitcoin, right? Gold is another example. Governments, to some degree, they have this sort of love-hate relationship with gold. There's lots of gold in central banks, and those are government arms that own and control that gold. As far as we know, well, let's put it this way: we don't know of any governments that are in Bitcoin yet. Although we do know about governments that are supporting Bitcoin mining operations in certain countries. And so that's developing.
Yeah. What's your opinion? Take Bitcoin out of the conversation again. No fines here, but what are the difference between cash and gold? What are your feelings there?
Yeah. My feelings are, and this is one of the things I do in the book, right, is I score gold along those 14 characteristics, and then I score the dollar along those 14 characteristics. And it's pros and cons. Gold obviously is harder money. It's harder to produce. Dollars can be printed at the push of a button, as we've really, it's as has been highlighted this year, 2020. They printed trillions extra. So that's a major, distance or difference. Cash, obviously, cash dollars. The dollar can be divisible more easily. Depending on if it's electronic, it's easier to transfer dollars over long distances. Gold is more long-term stable in terms of its value, right? It holds its value over time, although dollars are short-term stable. So, if you've got a short time horizon, you probably want to hold dollars. If you got a longer time horizon, you want to hold gold. If you say, hey, Andy, you can't hold Bitcoin for the next decade, but you have to hold either dollars or gold for a decade, I probably choose gold. I don't think Bitcoin will obsolete gold within a decade, although it's possible. But I'm pretty sure that they're gonna debase the value of those dollars for me over the next decade. So, right. Yeah, I'm not sure I want to review. I'm not sure it's worth our time to review, along all the characteristics. But there's definitely some pros and cons there.
Yeah. Without getting political, I'm not interested really in who even if you vote or don't vote or whatever, but how do you think the election affects the markets and Bitcoin?
Yeah. So one of the things I mentioned earlier is whoever wins the election, they're still going to print tons of money and run big deficits. So right. I would say that if it's a Democratic sweep, we probably get bigger spending. We'll get higher taxes, obviously, but probably the spending is even bigger. If it's, Republican, majority maintained, we probably keep our lower taxes, but still get a decent amount of spending. If it's a combination, right? If it's split government, then it gets a little dicier because it may be harder for the parties to agree. Nevertheless, I think they'll find it in their heart to spend some money, to borrow and spend. So, part of me says it just doesn't matter all that much. I can make arguments about which is a safer regulatory environment for Bitcoin, especially in the US. What's interesting about that is I tweeted about it the other day, and this gets back to the internet monopolist, stuff we talked about, which is I actually think, in October of 2020 was the date in which there was more regulatory risk to investing in, a big giant internet company than there's regulatory risk in investing in Bitcoin, right? Most people think about the regulatory risk or the government risk against Bitcoin is big. I say most people, most people in the world, not necessarily most Bitcoiners have figured out that the risk is small, but we're in a time period where I look at the regulatory risk, against, I don't know, Facebook or Google or Apple, and I compare it to Bitcoin, and the new licensing regime for banks in Wyoming that hold Bitcoin, the clarification that came out of control of the currency that said outright that U.S. banks can hold Bitcoin, can custody it. And then of course you've got. What's that?
Do you think that's happening? Do you think maybe that was some sort of sly indicator that the United States government is holding Bitcoin through a national bank?
Anything's possible. People talk about who's Satoshi, where did this thing come from? Who owns what? That's one of the interesting, fascinating pieces of the game theory of Bitcoin is, you don't know really right. who's holding some of this stuff. Yeah, it could be. It would be great, I think, if the U.S. government owned some Bitcoin. I think that it could go in that direction. We could get this period of some government or some central bank somewhere declares that they own some, or it comes to light, and then you've got this competitive race. I hope, and I think we're going to see that sooner in the corporate sector. This surprised me, right? This was Michael Saylor and MicroStrategy, and then followed by Square and Jack Dorsey. That was the starting gun for companies, for public companies, and it caught me a bit by surprise that the corporates came in at this time. And I think it's great for Bitcoin.
Does that change the conversation with your clients? corporate treasury and the activity of MicroStrategy and Square?
Yeah, of course. Every bit helps. Every one of these news events is positive. It just makes it more mainstream. Yeah.
Yeah. Do you think there's going to be a Bretton Woods 2.0?
Yeah, you mentioned my appearance on Kaiser Report earlier, and he asked me that question, and I think we're going to have, I don't know, the opposite of that, in the sense that, in theory, well, we know the money is really broken. So, do we need a Bretton Woods? Yes, we need a Bretton Woods, or we need a new system. But Bretton Woods was an outcome that occurred after a massive war where there was a clear winner. And that winner got to dictate terms for the most part. That was the U.S. And also the winner there was, 40 or close to 50% of world, output of GDP. Like the U.S. economy was close to half the world's economy. We don't have that kind of situation at all. Oh, and that was the other thing is, despite, accumulating all this debt, racking up all this debt to fight World War II, the debt levels back then were still lower than they are today, right? So we got even higher debt now. So are we gonna have a hard money standard, which Bretton Woods sort of was, based on all these governments in the world coming together? I think almost no chance of that. I think it's going to be the opposite. It's going to be monetary anarchy. It's going to be everybody print and debase those government monies as fiat currencies as fast as they can.
Yeah, no, I hear you. So let's take that original thought before about, the person who pops their head up. Now they've just heard the whole talk and they're like, okay, I get it. Things are, dicey right now. And I'm hearing what you're saying about Bitcoin. Where is Bitcoin going and why is it important to me? But not just like where is it going, like in price, but why is it important to someone who's trying to look out for their future?
Yeah. So there's a few ways to answer that. It's really important to the people that really need it to transact because they don't have an alternative, right? And that's, people who are cut out of the financial system and, need to send money, remittances, right? There's millions of people globally who don't live in their home country and they send money home to their families and they end up paying these exorbitant fees to the remittance companies, Western Union, et cetera. And so, it's important for them. It's important for people, whose only option to pay someone, whether it's cross borders or whether it's in a country that has a really, hyperinflating type of currency. That's the people for whom it's most important. For most of us in the U.S., with a still mostly functioning financial system, it's important for a different reason. And that is avoiding this problem of too much money printing and the debasement of dollars and currency. For my clients, I see it as an investment with huge upside potential, very asymmetric, right? The upside is many multiples of your investment potentially, versus the downside. I mean, the downside of any investment is you lose 100%. I think that's a low probability outcome at this point with Bitcoin, and so I see it as a very attractive investment long term, and it's uncorrelated to other assets, at least historically. And from a portfolio management position, I'll tell you, Cedric, there's been a change in view for me as a wealth manager that other wealth managers, some have come around to, but I think a lot have not yet. And that is an asset class that I refer to as hard money assets. And most wealth managers, even the older ones, have made their entire careers in an environment where stocks and bonds were the things to own, right? And you have to go back to the 1970s to a period when there was real significant inflation, where owning hard money assets, and in that time, the game was gold, was the one thing that actually saved your portfolio, right? In the 1970s, gold went up like 20x, right? Like 2,000% over a decade. And stocks, did not do well. Bonds got whacked. And real estate kind of did okay, but the valuations on real estate were so much lower then that you don't have that margin of safety in the price of real estate today. So if we get an inflationary outcome, in the next decade, then owning those hard money assets is going to be really important, because it may be one of the few parts of your portfolio that earns you a significant return. I'll say, by the way, I'm not bearish on stocks. The sort of the magic the magic of the money printing system is, if they print enough money, stocks can still make a positive return. It may be hard for U.S. stocks to outpace inflation over the next decade. We'll see how it plays out. But I'm not saying by any stretch that owning stocks and bonds is going to be ruinous. What I am saying is that government bonds, which are yielding near zero in nominal terms, in a world where there is some inflation, so your real return, your inflation adjusted return is negative, it's hard to justify owning those bonds. So for me, and gold, the pet rock, which is viewed by many value investors as sort of this useless inert asset. Well, it starts to look pretty good when your bonds have a negative inflation adjusted expected return, right? So what I tell people is gold is the new bonds and Bitcoin is the new gold. So we have, my expectation, this is my opinion, is that we're going to see this market share shift in terms of investment, which is investors rotating out of quote unquote safe bonds, government bonds, low yielding bonds, and rotating toward gold. But meanwhile, people rotating out of gold and into Bitcoin, because they figured out that Bitcoin is better, harder money than gold. And so that's the way I see it playing out. And none of this is investment advice. Everybody's situation is different. But if I look in aggregate and I think about how this asset allocation is likely to pay out, that's how I see it, as this new hard money asset class becoming important in a way potentially that it hasn't been in decades, and in Bitcoin grabbing and eating a bigger and bigger share of that asset allocation. That's how I see it.
Yeah, no, I agree. I know we didn't cover it all. This has been awesome. I really encourage everyone to go out and read Why Buy Bitcoin. It's not just for no coiners and pre-coiners. It's for Bitcoiners too. But I really think that the codification of this tomb for the investment thesis on Bitcoin from a very foundational wealth advisor viewpoint is immense for the space, and I'm just psyched to see where this goes. I think you're going to see it all over colleges, universities, and corporate America, especially the C-suite. If you're a CFO or CIO and you don't have this book on your desk yet, you're behind. Like I said, we didn't cover it all. Is there anything else that we missed? Before we
No, look, you asked some great questions, Cedric. I really appreciate your kind words about the book. It's been a pleasure, talking with you about it. I'll probably, give the usual things where you can find me. Of course, the book is as you said, Why Buy Bitcoin: Investing Today and the Money of Tomorrow. It's available on Amazon. It's also available on Apple and a couple other places. Follow me on Twitter. My handle's Edstrom Andrew. And of course, as you know, I've been advising Swan Bitcoin, head of institutional there. So their Swan Bitcoin's product is SAT stacking, automated saving in Bitcoin, right?
Yeah.
In a world of depreciating fiat currencies, we help people stack their sats and accumulate over time. Yeah. So and then I've personal website andyedstrom.com if you want to check out other podcast appearances. Yeah. So this has been a real pleasure. Appreciate the great questions and your kind words, and thanks for the talk.
Yeah, man, this has been great. Read the book Why Buy Bitcoin, and then you should go to then Swan and start buying Bitcoin. I really appreciate this, Andy. This has been awesome. Peace. Andrew Edstrom with the reasons you should buy Bitcoin right here on the Bitcoin Matrix podcast. And thank you for listening. If you dug the show, please vote with those thumbs and press those 5 stars. That's the best way to spread the word. This is Said. Peace out.